Pot stocks burning out today as what's been a bad month gets even worse. JP reportedly telling its prime brokers it will no longer allow them to buy and sell shares of some U.S.-based cannabis companies. The news comes after similar moves by Cowen, which has placed restrictions on pot stock trading, namely increasing margin requirements. Tim, what does this do for the trade overall? Has this impacted you at all?
So, look, I run a cannabis ETF, and actually cannabis is my prime broker, and they haven't pulled back at all. I think they've done a great job in the space. I think Cowen, and I think Cowen is holding a different line than JP Morgan and even Credit Suisse, who I think are going to be on the wrong side of history on this. I mean, look, if you listen to the Attorney General, he's not going after cannabis enforcement. If you've listened to the Supreme Court, they pushed on the Senate to basically say, look, you have to solve a problem where over 85% of the country has cannabis legalized in some form. The states are doing what they're doing, and yet banks can't operate, and people are carrying around bags of cash. I mean, this is a major problem for investors. The good news is you're investing now in a sector before a wall of institutional capital can get in. And I think for the banks that have chosen to be here, it's profitable. And the enforcement risks, I can't speak as an enforcement official. I can just tell you what's going on, and that is not where the risks are. And so I think if you look at the sector, we're about to get into third quarter earnings season. You're going to have a sector that year over year is probably growing 40%. Yes, third quarter numbers will show sequential slowing over second quarter. And I think there is some concern that margins can't hold mid-50s EBITDA margins, but this is potentially a $100 billion sector in less than 5 years. And I think investors that are understanding where you can get growth at a reasonable price, the cannabis as a sector, as a growth sector, is trading at a significant discount to sectors that don't offer this kind of growth. So frustrating as someone that runs an ETF, although I'd say on a day like today, some of the names in my portfolio went higher because they are Canadian names or they are ancillary names that will probably see proxy play flow more than some of the U.S. plant touching that I also own.
I mean, the issue here, the root cause issue, is that it's federally illegal, even though it's legalized on a state-by-state basis. And so that's the underlying issue here, Grasso. And that's one of the reasons why Tim had mentioned this wall of institutional money that's waiting to get in. That federal illegality is one major reason why we haven't seen the floodgates open completely to this sector.
100%. That's why Safe Banking Act is so important, and that's why that has to get passed, and it will eventually get passed. There's just so much on the docket up on Capitol Hill that we're seeing this stalled. But I do agree with Tim. Once you see that act get passed, these companies can actually conduct business and operate like businesses. When you look at a stock like Cronos trading at $5.50, down 20% year to date, that's ultimate idiocy to me. When you look at a stock like Tilray with Irwin Simon at the helm, who's a tremendous operator, that's idiocy to me as well, where these levels these stocks are trading at. But all these banks, to Tim's point, are way behind the curve. It's almost the same thing that they're doing with Bitcoin, but this is even worse. They're so far behind the curve here that once they do have to do a 180 with safe banking, once that's passed, these stocks are all going to be multiples higher than where they are now.